Hello traders and welcome back to my YouTube channel IPDATrader. Now in today's video we're going to be talking a little bit about imbalances, right? How they look, what they form, what they mean, how we can implement those ideas in our trading and essentially have a little bit of a higher probability whenever we're executing our positions, right? But before we actually dive right into that, I wanted to make a couple things very clear. One of them being that imbalances alone will not shift your entire outlook in trading, right? You will still need to validate those ideas with other potential tools such as structure, liquidity, points of interest, confirmations, and all that sort of stuff, right? I'm just going to be giving you my perspective on imbalances, how I see them, what I use them for, and how you can potentially read imbalances and implement those ideas into your trading, right? So with all that information being said, guys, if this sounds like something you want to learn today, make sure you stick to the entire video because I'm going to be trying my best to provide you as much value and information so that you can then go ahead, look into the charts and sort of see if those ideas actually make sense to you, right? So let's actually get started discussing imbalances. So traders, let's actually get started discussing imbalances. And just to give you a quick and brief definition so that everyone is sort of able to understand the concept, an imbalance is nothing more than the distance or gap, whatever you want to call it, in between wicks, right? And just to illustrate that idea for a second, right, what I've just told you, let's actually take a look at this GBP JPY 3-hour chart. We're looking at this chart and let's actually focus specifically on this candle over here coming down bearish, right? So applying what I've just told you, we should now be able to understand, right, that the gap in between wicks is considered the imbalance, right? So this is a wick over here. This is another wick over here at the time, right? Where just imagine this price action to the right is not there yet, right? This candle, this bearish candle has officially it's officially printed on the charts, and now we're looking at the imbalance idea, right? So at the time, this entire section over here is known as your imbalance. Now, as the next candle, this sort of doji candle starts forming, we can see how we initially go up, and that is all to do with candlestick anatomy, which at this point you should pretty much be aware of, and you should be trying to implement those ideas as well in your trading. But as you can see, this candle has a huge amount of imbalances, so the following candle sort of wicks up a bit, fills a little bit of that imbalance. Once again, not the entire thing. Now our imbalance has been reduced to this wick, from this wick over here to this wick over here, right? And we continue lower, but we eventually come back up and fill all this imbalance over here, right? And just to give you another example, once again, this was the example of a bearish imbalance over here. This entire activity of selling is considered your imbalance, and you should understand that at some point in time, that is eventually going to get mirrored, filled, whatever you want to call it, with buy positions, buy side liquidity, meaning that this candle is most likely to get mirrored to the right as price starts trading higher, right? So let's go back in time and let's look for a bullish example over here, and this one is pretty easy to see. Let's now focus on this particular bullish candle over here. Same ideas, same concept, right? The distance between the wicks over here, right? This entire section is now known as your imbalance, right? And as you can see, sort of the next candle's range, and then we have this bearish candle that taps into the imbalance, fills a little bit of that, right? But it doesn't fill the entire area. Now our imbalance has been reduced to this particular price action and section price action over here, right? And as you can see, if we look to the right a little bit, that eventually gets filled and sell side gets offered as we trade into this imbalance, because that's how the market behaves, right? But now you have an idea on how imbalances look, and what they actually, how they get filled, right? But we're going to be getting more in depth in a second. This is sort of the bare bone definition of an imbalance, how they look, and a little bit of what they mean, right? But let me actually go back to the drawing board over here, right? And we're going to be discussing that idea a little bit more in depth. So let me actually quickly grab this tool over here. And as we said, guys, let's keep it simple. Imbalance, right? Imbalance equals gap distance in between wicks over here, right? So this is our bare bone definition of an imbalance, and let's actually put this into a little bit of a context, right? So let's imagine, for whatever reason it may be, you have a bullish point of interest over here, right? Whether that is a bullish order block, a knife C candle, and a few candle, doesn't really matter, right? You have a bullish point of interest over here, and you have price. Let's say we had an impulse over here which led into this point of interest, and now we have the market coming back down. And by the way, as it's coming back down, it's filling most probably imbalance if this is actually an impulsive move up. So but let's actually continue over here. Let's not get confused. So price is trading back down, is filling that imbalance. Keep that in mind, right? And now you're hitting your point of interest. And as you do so, you notice the compression as we trade back down, and you start seeing some sort of shift develop over here, right? So let's say, let me actually use the rectangle for this. We have a bearish candle closing like this, right? And sort of the next candle is a big bullish candle that takes off just like that, right? And the next candle sort of does the same thing. So now we've created imbalance, and let me actually denote the imbalance range over here, right? From this wick over here, this bearish top wick, right? And let me actually do that properly. This one over here to this one, to the wick over here, this entire area, let me highlight that. We can potentially use a circle over here. This entire section over here is your imbalance, right? And let me actually tell you what is most likely to happen as those imbalances appear, right? So if price then happened to start moving lower, let me actually grab the rectangle back over here. We then start moving lower, and as we start approaching this imbalance, right, there is a very high probability that this imbalance is going to get filled and sell side is going to be offered, right? So with probability, you're going to get a mirror effect happening over here, meaning that a bearish candle about the same size is going to get printed over here, so that this bullish imbalance, right, this entire imbalance area is going to get filled and sell side is going to be offered. Because the way the algorithm works is that buy side and sell side needs to be offered at all times in the market. So if we look at this initially, you should understand that at this point in time, if we don't have the bearish candles coming down, this is just buy side being offered, right? Let me actually grab a circle. This is just buy side being offered. So with probability, sell side is going to be offered over here because the algorithm needs to be balanced out, meaning that buy and sell side liquidity needs to be offered equal, right? Needs to be sort of balanced out. It doesn't mean that this imbalance, needs to instantly get filled. It just means that eventually this will get filled, and this is sort of what the algorithm does, right? If you have some experience with the charts, you will find, and you have potentially seen, this mirror effect happening multiple times, where if you have a sort of clean bearish candle coming down, right, as price then for whatever reason starts trading higher, maybe a week down the line, a month down the line, doesn't really matter, eventually it will come back up over here, right? Sorry, wrong tool over there. So eventually price will come back up over here, and this candle, right, this bearish candle with the imbalance is going to be mirrored to the right, because the algorithm is going to be seeking for that buy side within these specific price points over here, so that both parties in the market can be satisfied and happy, right? So keep that in mind. That is essentially the definition of a imbalance and how it essentially works. I do really hope that this made some sense to you. And now we're going to be getting back into the charts and sort of applying the imbalance idea with potential trade executions and how we can implement that to have a little bit of a higher probability whenever we're executing our positions. So let me quickly go back over here and let's actually start doing that, right? So as smart money traders, guys, we should understand that we have different tools that we use and implement in the chart so that we can view and trade the market, right? So let's actually take a look over here. We're now looking at GBP USD on the 3-hour time frame, and let's actually go ahead to the 4-hour. May actually be a little bit easier to see. By the way, guys, these cells were actually taken and posted in the YouTube community tab, so feel free to check that out, right? But let's actually see why cells were executed over here and combining that idea with imbalance, right? But it's not all about the imbalance, but sort of the imbalance helps you with determining your points of interest and potential sell and buy areas, right? So we look over here, right, at this particular leg coming lower. Now we print a new low, right? We understand that we have sort of this structural play, or at least for me, this is what I was seeing. Once again, structure and the markets are really subjective and open to interpretation. So this is what I was seeing and what I was expecting in regards to my experience and how I like to trade the markets, right? So I saw this leg coming down and now we start retracing back up. So I knew that as we were hitting those discounted areas over here, that it was a high probability that I can expect a new lower high to form, right, anywhere inside this area, and then continue lower, because order flow delivery is essentially telling me that, right? We had previously this leg coming down with tons of imbalances, by the way. If you look at this, this is a huge imbalance that got filled in about the 50% of it and then continued lower. But let's look over here, right? So how can we implement imbalances in our trading? Well, one thing you can do, which is essentially what has been done over here, is wait for points of interest which has imbalances being filled into those, right? So if we look over here, we had this point of interest. I'm not going to be getting into details, but this is a point of interest over here, and this is whoops, wrong tool. And this is an imbalance on the way to that point of interest. If we zoom into a little bit of a lower time frame, we may even see more imbalances even over here, right? But for now, we're going to be focusing on the 4 hours so that everyone is able to follow. So price starts trading back up, and now that imbalance is being filled as we trade into a point of interest. Now we're combining point of interest and imbalance, right? Now you can see how these tools, these different things that we use, actually work hand in hand and can be used to trade the markets. So we look over here, we print this low, we start retracing, we fill that imbalance. This point of interest over here is very well discounted, so this makes it a very high probability point of interest for me to look for sales, right? And let's actually now start looking for another example right over here. And let me actually see, right? So we look at this particular structure leg over here, right? We have a low, we have a high, we have some potential breaks in structure over here. So you may now be waiting for this origin block over here, as I always teach. Now, you see, and you say to yourself, hey, I'm waiting for this block because above that, we have plenty of liquidity and we have this imbalance over here that I want to see filled as we trade into my point of interest, because now I have a reason to believe that we could potentially look for shifts over here, right? Reason being is because liquidity is being grabbed and imbalance is being filled. So efficient price action is being delivered. So there is a very high probability that as we trade back into this block, and let's actually extend that out in time over here, this entire block, there is likely mitigations to be seen, right? And this is exactly what we get. We trade back into the block and we provide mitigations that then come back up and fill more imbalances, right? We look over here as we mitigate this block, price then moves up and fills more imbalance, mitigating another block over here. But once again, this is mentorship material, and then moves back down, creates a low, and this is sort of what we are at this point. So not only can you use imbalances as sort of an extra confluence into your point of interest, but you can use them as targets, right? Because if you happen to, let's say, get into a buy anywhere inside this area for whatever reason it may be, once again, we're just focusing on imbalances, right? If you happen to get into a buy over here, you know that you can hold that until thinking that this imbalance over here, right, this bearish imbalance at the time was most likely to be filled, which is exactly what happened, right? Price then filled that imbalance almost entirely initially, but then came back down and then it got filled eventually, right? So if you are trading the markets, right, and if you get into a buy position over here, you know that you can hold this trade into that imbalance fill, because as price is filling imbalance, it is very likely to move in a swift move. So hey, why not catch that as well, right? So understand that if you're trading the markets and you're getting into positions, look to your left, and if you're seeing imbalance, you are it is a generally speaking, it is a very good thing to just hold your trade throughout the imbalance, because that is likely to get filled into an area where then you should be paying attention to for potentially taking partials, closing your position, mitigating your risk, whatever it may be at the time, right? But just understand that if you have imbalances to your left, you are good with that position. You want to be sticking to that, because with probability that is going to get filled and you are going to be getting all that move and all those pips, right? So I really do hope this provided you guys some insight about imbalance, guys. Remember that the market needs to be balanced out at all times, so eventually imbalances get filled. Just don't go into the chart with the mentality that, hey, I see an imbalance, let's take a sell to fill that, right? You still need to understand the narrative. You still need to understand the story behind why price may be doing certain things, but this is just an extra nice tool to have for you to trade the markets, right? So that is pretty much going to be it for this video, guys. Remember that from an algorithmic perspective, a buy side and sell side needs to be offered. That is really a key over here. But with all that being said, guys, I'm just quickly going to mention that please stop getting scammed, because I've been receiving the same message over and over. This is the only page I will ever offer mentorship on. Do not send money anywhere else. Do not sort of let other people tell you, hey, this is IPDA, go join over here, right? I will never message you asking for money, so keep that in mind and be aware of that. But either way, guys, I wish you all good and profitable trading, and I will see you guys very soon.